What we've seen over the last 10 years is that, and this is clear in the data, is that stocks, single stocks, sectors, indices, the big indices, whether it's FTSE or S&P 500, are all increasingly influenced by economic growth, inflation, monetary policy, China, emerging market volatility, energy prices, commodity prices, macro. If you look at the COVID crisis, global GDP growth went from 4% to negative 20%. Well, that's going to have an impact on stocks. But there's another reason as well, which is really interesting, and that is that one of the big banks did some research 2 years ago that showed that 60% of equity flows in the US are driven by passive investors. Now, passive investors buy indices. They'll buy the FTSE, they'll buy ETFs, they'll buy the S&P 500, they'll buy NASDAQ. They're not actually doing individual company analysis. And their behavior is very much driven by their employment prospects, where interest rates are, GDP growth. And so you see that macro is impacting markets a lot more through this passive investing style that's now dominating.